Here with Annie Mac Works. I want to welcome you to our National Lunch and Learn League event, Multi-Family Magic. This afternoon, co-founder of Annie Mac Works, Russ Fitzpatrick, is joined by Catherine Parcell to talk to you guys about alternative lending solutions. We hope you enjoy. Take it away, Russ.
Well, good morning, everybody. My name is Russ Fitzpatrick. I'm the founder of Annie Mac Works, the Worksaholic Nation, the realtors all across the country that we serve with Annie Mac Home Mortgage. And it's my job today to open up some new opportunities for you guys, the realtors. My world was shook about a month ago because I've been buying investment property my whole life. I've done deals for a lot of my clients in multifamily and in investment properties, but I've never been involved in a non-QM mortgage. And after 37 years in the residential real estate space, I saw a presentation a couple weeks ago that just blew my mind as it relates to regular families that want to buy investment property, self-employed individuals that, like me, I've been on a 1099, self-employed my whole life, and I always struggled with how to finance some of these projects and some of these opportunities that my W-2 friends can document their income properly and do these things. So when I saw this, I asked for Catherine Parcell, to come on and explain the non-QM difference to me so that I could then share it to our realtors across the country. So I want to thank Catherine Parcell for coming on and just clarifying some of this crazy new stuff that's available for self-employed and people who have a harder time documenting their income. I appreciate you being on, Catherine. How you doing?
I'm great. Thank you so much, Russ, and thank you all for listening in today. As Russ mentioned, we want to open your eyes today into some alternative financing options that many loan officers, as Russ alluded to, are not yet aware of or have adapted this strategy of attempting to serve a lot of these underserved borrowers when it comes to that traditional product. So, our whole presentation today is about partnering with companies such as AnnieMac and loan originators such as Russ and their team there that's going to be able to look at every borrower and every opportunity to open up that home ownership objective to that particular consumer. We're going to talk first about what is non-QM. We've used that term several times already. So let's talk about what exactly does that mean. And then we're going to talk about the market overview. What does this non-QM market look like? Who does and what does that non-QM borrower look like? And then we're going to go into all the solutions that Annie Mac and the team there are going to be able to provide borrowers outside of your traditional full doc, W-2, pay stub, tax return documentation that all of those traditional products allow. Now, we do welcome questions, so please do feel free to ask. We don't view that as an interruption. We view that as interaction. So at any time, feel free to speak up. Let's talk about what some of the characteristics of a non-QM loan is. One, it expands debt ratios higher than what agencies generally would allow. It goes to a 50%. Non-QM also allows some different terms in relation to the length of time a borrower can finance. Non-QM offers a 40-year term. We know there is some affordability issues in the market. You see it as agents all the time. So that 40-year term is certainly going to assist. We also have interest-only features. So as Russ alluded to, he is himself an investor. And as we know, investors are all about what? The cash flow of that property. So that interest-only feature is very attractive, especially to the investment community. There is no PMI or private mortgage insurance for the agents who are not aware of what that is on a traditional or conforming loan. Anytime you put less than 20% down, you're required to buy this insurance. It doesn't insure the borrower, it insures the lender. Well, in the non-QM space, that doesn't exist. The borrower can indeed go put less than 20% down and not have to pay that private mortgage insurance. The highest use and the biggest characteristic of the non-QM product that's utilized nationally is the flexible income sources. As you heard Russ talk about being a 1099 borrower himself, and you as real estate agents, you're 1099 borrowers too. That often does create a problem. We all like to take that IRS tax code and use it to our benefit, take all those legal deductions that we can, net that income down, and that often presents a problem. Not only for the 1099 borrower, but for investors as well. So, we're going to talk today all about these flexible income sources to help these borrowers qualify. These are manually underwritten loans. What does that mean? When we do any other type of loan, your government loans, your FHA, your VA, your Fannie, your Freddie, your conforming loans, they all get run through a automated system, AUS. That system analyzes the risk of the borrower and gives the originator an approve or an accept or a refer, right, or ineligible decline. Here you actually have a human being analyzing the risk of that particular borrower. So it affords some common sense situations to take place. And it also offers underwriters to look at the totality of the borrower in their certain circumstances and often make exceptions outside of what traditional guidelines are. Now, non-QM is expanding, so we're glad you're listening in today. You are going to hear more and more about non-QM. This is the one area of mortgage originations that is growing. It is expanding. It is supposed to double this year. Why is that? Well, first off, we have more self-employed and 1099 borrowers in our country than ever recorded in the time that number has been tracked. So that would make sense that they would need more solutions and this product would grow. The other reason non-QM is growing is because originators such as the AnnieMac team, they are adapting a non-QM strategy. They have taken this time in this constricted market to educate themselves on other products to help qualified borrowers achieve their home ownership dreams. So we're happy to see that occurring throughout our country. The other reason we see non-QM growing is because once you're able to say yes to a borrower that somebody else told no based on their tax return, they're certainly going to refer. They're going to talk about that. Like borrowers hang out with like borrowers. If I'm self-employed, I know more self-employed borrowers. So indeed, it strengthens our client base and our referral base. So non-QM is really here serving that underserved borrower. I do want to talk about the credit quality for those agents who may be listening and you went through that dark day of '08, what we may deem as that old subprime market or that foreclosure crisis. I want to fast forward and talk about what non-QM is today. It is not that old subprime market. These are responsible loans. There is ability to repay that has to be met. And we're dealing with a well qualified borrower. The average FICO nationally, that's what WA means, weighted average, nationally is 742. I think by anybody's standard, that is a solid FICO. The average LTV is 70, meaning what? They either have a 30% down payment or if they are refinancing, they got good equity. So these are borrowers who are qualified. Their average debt ratio is 33%. So why are they here getting a non-QM loan? 51% of the time, it's simply because that borrower is self-employed. They are the highest user of the non-QM product and the highest demographic of borrower in our country being underserved in the traditional market. So we're going to talk a lot today about those solutions for that self-employed. We're also going to talk a lot today about the investor. They are the second largest group of underserved borrower, and these are very active borrowers. This is a very consistent borrower, more insulated, if you will, to the rising rate markets. Statistics from the IRS say that the consumers claiming rental income has increased every year since 2006 by 7.3%. These rates are not stopping the investor. They understand cash flow. and they are very, very active. So we'll talk a lot today about how Annie Mac and the team is going to be able to serve that investor outside of those traditional products. Let's talk first about the bank statement program. What is this? This is a program for the self-employed borrower who would like to use the deposits in their bank account in lieu of using their tax returns to qualify. So they've taken all their legal deductions. You get to that net income, and it creates a problem qualifying for that property. Well, utilizing the deposits in that bank account to come up with that borrower's usable income will net that borrower often more income and certainly can get them to the price point that they'd like to achieve when they're purchasing their properties. There is no IRS documents needed, so you don't need your tax returns to be submitted. You need 12 or 24 months of personal or business bank statements. Most of the time, 12 months was sufficient. Only time the team really asks for 24 is for a seasonal business to get a better average of that borrower's deposits and income. Now, we're going to calculate that income in advance, just like we would any other loan. We'll get that income calculated for you within 24 hours so that we know within 24 hours of receipt of those bank statements what that usable income is. Just like we would on any other loan, we're going to verify that borrower's income before we tell them what their purchasing power is. Now, you can still go with a lighter down payment. 10% down is the minimum. As we saw from the opening slide, most of these borrowers have a substantial down payment, but you still have that option for that 90 loan to value. Loan amounts go as high as 3 million. So if you're an agent who has those jumbo listings, those prime jumbos are sometimes even more stringent to qualify for than an agency loan. They have to higher allowance for that borrower's debt structure. They usually require higher reserves. They are all full doc. That self-employed borrower who has a great tax strategy has no other way to qualify for that jumbo product without the tax return. So here, all the way to that 3 million, you could help that self-employed borrower on those jumbo properties. If you are in the non-warrantable condo market, you have those listings in the non-warrantable condo arena. All the features we show you today and all these income solutions we show you can also be used for that non-warrantable condo. So great opportunity there to have another option or outlet for that type of financing. These do go to 4 units and, of course, all your traditional single-family PUDs, townhomes, etc. But we wanted you to be aware, condos and non-warrantable, as well as 4 units, the borrower can use this feature. Now, whether they're purchasing that property for primary, second home investment, if they're self-employed, this is a viable solution outside of that tax return. We also run into self-employed borrowers who have dual sources of income. I own Cat's Landscaping and I also own 3 rental properties. I don't want to use my tax return to qualify. If I've got dual income, I probably have a very good tax strategy, right? So you have that ability to document the rental income via a 3-month bank statement. So once again, more flexible sources for investors. We have a second option for that self-employed borrower that may want to go a little lighter on the documentation. It's called the 1-year profit and loss. We simply get the borrower, instead of their tax return, in lieu of the tax return, they get a third-party prepared profit and loss. We are going to look at the net income off of that profit and loss when we're qualifying that borrower. We do that in lieu of the bank statement feature, in lieu of a tax return. It is a separate option that the team will look at as you send your referrals over there to Annie Mac. Remember, no IRS tax documents needed. Loan amount goes here to 80. If I'm using this lighter, adjust my P&L to qualify, then I need to have a larger down payment. Doesn't matter again, owner occupied second home or investment. If I've got a self-employed borrower, here's yet another solution the team can look at. Again, all the way to 3 million. Still can do your non-warrantable condos. As we've mentioned, every alternative income feature across the board on that non-warrantable can indeed be used. There is
Catherine, did
another,
you just,
yes,
Catherine, do you mind if
yeah,
I interrupt?
no,
Did
not
you
at
just
all.
tell me that my accountant would prepare a P&L and submit it to you, and then that would be my proof of income? I hadn't heard that before. Is that what you just said?
That is correct. And this is a feature that we just rolled out on April the 19th. So it gives borrowers often who may have more sporadic deposits, right?
Mm,
Um, and don't want to go through that 12-month bank statement feature. I've got a second option, right? Now you can
mhm.
ask that borrower for that 1 year P&L. We'll do the math on that net income and divide it out and utilize that as income. So it's a lighter documentation than the 12-month bank statement, and for some borrowers may work better. So the beautiful thing here is the originator will be able to look at each individual self-employed borrower and decide what solution is going to be best for that particular business.
Amen. Thank you.
Thank you for the question.
Mhm.
All right, let's go for another solution. Now, asset utilization is a feature that can be used across the board. I don't have to be self-employed to use this asset utilization feature. Asset utilization, what this is it's going to give the originator the ability to use the borrower's assets as income without the borrower having to be of retirement age. They can even use their retirement account as income. The borrower doesn't have to liquidate that asset. We all know right now moving money around is a little tenacious. So these borrowers get to keep their assets intact. The originator's just going to ask them for all their assets, and we can use them to solve various issues for borrowers. The first issue we could solve for a borrower utilizing their assets as income is if I have a debt ratio problem. Remember, we said non QM can go to a 50% debt ratio, but what if I am at 53? Instead of asking that borrower to put more money down or, heaven forbid, purchase less of a price, right, or pay off that truck loan, all those other solutions that could solve a debt ratio, the loan officer can gather the bank statements on the borrower's assets, even retirement accounts, give the borrower credit for the balances, and divide it out by 84 months and add it to their other income without the borrower having to do anything but turn over their asset statements to the loan officer. The other way asset utilization can be used is there are a lot of borrowers who have employment challenges or don't necessarily meet the employment requirements. When we look at mortgages in general, borrowers have to have a 2 year work history. Doesn't matter what type of loan they're getting, right? They have to have a 2 year work history, unless, of course, they're retired. If they're self employed, they still have to be self employed for 2 years. What do we do with those borrowers who can't meet those guidelines, but they have assets? They have heavy assets. Asset utilization can be used to negate any employment verification, income verification, or any debt structure looked at for the borrower. Now, mind you, they do have to be someone with, sufficient assets, and your loan originator will know all that math. The point being, it's yet another way originators will be looking at these borrowers and every possible solution to get them to that home ownership that they're desiring. So FICOs here are 660. So remember I said in the beginning that these are responsible loans. Um, they are. That's why there's a minimum FICO requirement, right? Now 660 is not perfect, but it's a mid score. It's a good score, so they can use uh, that asset utilization feature. Again, up to 3 million. Assets don't have to be liquid. My retirement account that I can't get at, I can use that as income without having to liquidate that. Doesn't matter if I'm owner occupied second home or I'm purchasing that as an investment. So again, think of all the solutions in that second home and investment category, right? We know Fannie and Freddie have tightened or had some concerns, if you will, in that second home or investment area. So these products open up a lot of opportunity for that particular occupancy type. The last feature or solution we want to talk about is debt service coverage ratio, better known as a DSCR loan. You may have heard of it called a cash flow only loan. What is this DSCR? This is a feature for investors where we don't have to verify any employment. That the employment isn't even asked where they're employed. We don't look at any income. There's no income documentation at all that the borrower has to produce. Therefore, we wouldn't look at the borrower's personal debt structure. Your ability to repay is based off of the cash flow of the subject property. So the concept here, can the gross rental income that borrower could bring in on that property cover their proposed payment by three-quarter or higher? On purchases, that borrower does not have to cover their payment by 100% or more. That would be, of
This is
course,
Catherine. This is probably
yeah.
the most interesting product that I've seen. I'm with a lot of let's call millennial ambition, right? I want to get into multifamily. I want to get into multifamily, right? And I show them a triplex that brings in $5,000 a month in rent. But in the past, I couldn't qualify them because let's say they make $90,000 a year and they already own a single family home. They're trying to buy a triplex and there's no way it just won't work. This product would use the $5,000 a month that's historically been coming in on that triplex to qualify for the loan.
Yeah, let me show you how the gross rental income is calculated. And I think you made a really great point in reference to why we see that uptick, right? That 7.4% more year over year of consumers are reporting rental income. If we think about the fact that, many corporations, there's no longer that retirement, right? That pension. And so many folks are looking at real estate as a retirement plan, right? And the millennials are getting in early. And I think you make a great point about the demographic of borrower that could use this. So here's how we are going to look at the rental income on a purchase, or a refi. If there's an executed lease agreement on that property already, we're going to use lesser of the lease agreement or the market rent from the appraisal. For the agents out there who may not be familiar with these forms, anytime an originator does a property, finances a property that is being utilized for investment purposes, they ask the appraiser for these addendums. What do these addendums do? They tell the lender what the average rents on comparable homes in that market are. So we're going to use lesser of the lease agreement or that market rent from the appraisal. If there's no lease agreement, you simply use whatever that market rent from that appraisal is. Now, the key here is in the non-QM world, borrowers get credit for 100% of that income. In the agency or conforming world, loan officers have to cut that income down by 25% to allow for what the agencies deem as a vacancy factor, meaning they don't believe that this property is going to be rented all year, every year, that 25% of the time it's going to be vacant. So they cut that income by 25%. Here, you don't have to do that. You get to use 100% of that calculation. There is also an allowance for that property that may be leased. And if the lease is a higher monthly rent and you need that higher monthly rent, you can document from the seller, or if it's a refi from the borrower, that they've received the most recent rent from that higher amount for the last 3 months, and then you can even use that higher amount. So again, these are all details as agents that your originator understands. They're experts here in these products. and they're going to be putting the pencil, if you will, to your clients that you send to them to make sure they explore all of these avenues to qualify these borrowers. You could even ask to do preliminary data on your listings, right? Rent.com, Trulia.com. Ask the originators for a proposed pity on your listings. It may help to offer this in some of your advertisement for that property and open up more investors to the listings that you currently have.
Can I ask you a quick question, Catherine?
Yes,
So let's say it is a vacant duplex. It's never been rented, just hypothetically, or even a duplex. Let's just go with that. It's vacant. There's no leases in it, but the appraiser says they're going to rent for $2,500 a side, but there's no renters in it now.
you, you
How does that calculate in the real world?
you use the market rent from the appraisal. If that appraisal says each unit is $2,500, each unit gets $2,500 rents. Yep. That's
Okay.
all you do. Whatever, if there is no lease agreement, then meaning it doesn't matter if it's, when I say no lease agreement, that could encumber a lot of things, right? That property could be vacant. An investor could be buying somebody's primary residence. An investor could be buying somebody's vacant home. They could be buying somebody's second home, right? So when we say there's no lease in place, meaning could be vacant, simply could be it's
Yeah.
somebody's buying somebody's primary or their second home. So you just go by what that appraiser says.
Got
Yeah.
you.
Mhm.
Interesting.
Yeah, remember they don't have to supply any employment, they don't have to supply any income, and we don't look at their debt structure. We're simply looking, does that calculation from this gross rent cover their pity depending on their loan amount by either 1 or 3/4?
These are typically 20% or 30% down purchases.
These are a minimum. When we look at our DSCR loan, 80% is the max loan to value. So an investor would need 20% down.
Yep.
They do need a minimum of a 660 FICO. So again, these are responsible loans. We all lived through '08, right? We need a good FICO to negate any employment income or debt structure. Loan amounts here go to 2 million. So still open in that jumbo territory. You can still do the non-warrantable condo. Often it's the investor who makes the condo non-warrantable. So great opportunity there. We even will help first-time investors. So if I have no landlord experience, and this is my first, as Russ alluded to, getting a lot of phone calls from millennials perhaps wanting to enter in and become investors, it could be their first investment property. They can use this to qualify, they just need a little lighter down payment. There's no cap on how many properties a borrowers can have financed. For those agents who may not know, your conforming products, your Fannie Freddie products, they limit borrowers to 10 financed properties. Once that borrower gets to 10, the conforming world says, sorry, we're not going to help you anymore. There is no cap here in the non QM. It's unlimited finance properties for the borrowers. And they also don't need additional reserves on all the additional finance properties they have. In the agency world, they do. So it's very much a lower dock, lighter way for an investor to qualify if indeed they can't be served with that agency loan. Any other questions on that?
No, I just think it's a very exciting time in the mortgage business with a products like these are opening up. All of my realtor friends were self-employed, right? And we'd be like, how the heck do we get into some of these properties with this challenge? But I applaud Annie Mac for bringing you in to educate our originators to help our realtors just fund more properties. It's a great time for us to expand our products, but it's also a great time for our realtor partners to be able to reach out to millennial ambition investors, or even guys like me that felt like we were locked out of multifamily in the past. So it's a fantastic opportunity, and I appreciate your time on it.
Well, we thank you all for having us. We thank you all for tuning in. And again, please utilize your Annie Mac originators and team over there. They really will do their very best to serve these underserved borrowers and think outside of all those traditional products everybody else is selling, right? So, again, thank you, and we hope you have